And so the debate really is, does traditional diversification, stocks, bonds, real estate, et cetera, give you adequate hedging properties to protect you against a catastrophic loss, or potential catastrophic loss, or half of a catastrophic loss, maybe like we saw in the Coronacrash? So, it's our belief that asset diversification is vital in a portfolio, but doesn't go far enough. And this is why we add trend following to it. We call trend following time diversification, but because it diversifies both the assets across time, the allocations across time, and the different time frames or look back periods that we use to measure trend. So what we wanted to show at Blueprint is, look, we believe in tail risk hedging, and we do that through trend following and through non-correlated assets like gold or government bonds in some cases. But our chief objective, one of our chief objectives, is to protect against catastrophic loss, and another is to improve behavior by circumventing emotionally charged environments. Now, these are reinforcing issues because catastrophic losses tend to be coupled with or a catalyst for bad behavior, because they are emotionally charged environments, or they typically are. So for us, doing one is accomplishing the other. And so what we wanted to show you and review is that when it mattered in the first quarter, Blueprint Growth, S20, that means this is our 20% strategic strategies, 20% of the portfolio is bought and held, 80% is tactically driven. So downside protection, when it matters, showed up for us in March of this year. And this graph goes from the beginning of January to the end of March. And you can see here, Blueprint Growth had fairly close to touched off about a 20% drawdown. That's peak to trough, Feb 19 to March 23rd. But we compared it to other indexes, and this is a randomly selected group of indexes that are both all stock, some are market cap, some are factor. And you can see here that the value index had a 50% drawdown from February to March. Now, we're all familiar with the math that a 50% drawdown requires 100% return to get back to break even. 40% drawdown requires a 67% return to get back to break even. So you can see the difference in both the client's emotions given the relative choices of, okay, I could have a 20% drawdown or a 40 or 50% drawdown. And then the amount needed to recover. You need about a 25% recovery to get back to new all-time highs if you lose 20. And so the point here is that robust strategies like Blueprint Growth that use trend following can protect against these catastrophic losses, and did protect against them in Q1 when you needed it the most. Some of the other factors that are looked at as more defensive factors did not. In fact, pure value, RPV, had a drawdown equal in magnitude to that the drawdown that it experienced in the financial crisis of 2008, 2009. So drawdowns can and will happen, and it's a matter of having a plan ahead of time that can react to the downfall and the downside moves in equities in order to allocate away from these asset classes in order to preserve capital and hopefully result in a higher probability that clients meet their goals. And that's what we're about, because we know that's what you're about.